Hi. In a couple of weeks, one of the storied names in the automobile business, Ferrari, is planning its initial public offering. Now, all IPOs are interesting, and they're interesting often for different reasons. And the Ferrari IPO gives us a chance to put brand name under the microscope to see how much effect it can add to value. Let's go back in time. Ferrari was founded by Enzo Ferrari, who used to work at Alfa Romeo, created a company that supported Alfa Romeo racing teams, and eventually built his own car in the early 1940s. But it wasn't until 1947 that Ferrari started producing its own cars from its factory in Maranello, which remains its home base. Now, to get some sense of the Ferrari legend, you got to look at two places. One is, of course, the racing tracks, where the car has won more Formula One races than any other automobile company out there. But the other is the celebrity circuit. For better or worse, Ferraris have been associated with the young, the rich, and often the irresponsible. So celebrities around the world, from Justin Bieber to Kylie Jenner to Thor Batista, have used Ferraris to put themselves into some trouble. So whether it likes it or not, the Ferrari legend comes from both the racetracks as well as the celebrity circuit. But the car is a legend. Now let's set the table. Ferrari is an automobile company, and that's bad news because the auto business is not a good one. It's not a good one because for the last decade, revenue growth has slackened off, and this is in spite of the higher growth coming from Asia and from China in particular. The operating margins are razor thin. In fact, the average pre-tax operating margin last year across all automobile companies with a market cap greater than $1 billion was only 4.5%. And third, this is a company that increasingly needs big investments, not only in the traditional assembly lines and the plant and equipment, but in R&D as the business becomes increasingly technological. So if you combine low revenue growth with low margins and high reinvestment, you have the recipe for a disaster. Here are the saving graces of Ferrari. It's part of what I would call a segment of the automobile business called the super luxury car business. Not just the luxury car, but super luxury cars. These are cars with 6 or even 7 digits in their prices, and they're sold to relatively few people. What's made this business different than the rest of the automobile business is first, it's a low volume business. They don't sell very many cars, but the number of cars they've been selling has been growing as the number of rich people in Asia and Latin America has grown. The second, unlike the rest of the auto business, the super luxury auto business seems to have much better operating margins. And third, because they have a low growth strategy, these companies tend not to reinvest as much money. So if you look at the Ferrari value proposition, it comes from, in my view, from 4 very simple factors. The first is styling. A Ferrari is a work of art. It's not just an automobile. When you drive a Ferrari, people notice. Second, their speed. I know none of us will ever get to test the top speeds in a Ferrari, but if you grew up wanting to be a racing car driver, this is perhaps as close as you're going to get to a Formula One race. Third, there's a story. And that story, as I said, comes partly from the racetracks and partly from celebrities. But when you ride a Ferrari, you're already a semi-celebrity. And finally, and this is, I think, a critical thing to remember, is the Ferrari value proposition comes from scarcity. If everybody had a Ferrari, I don't think you'd be willing to pay $1 million for a new Ferrari. So its value comes from from keeping its numbers under check. And that gets reflected if you look at Ferrari as in terms of its sales last year. It's a pretty exclusive club, and it's a global club. Last year, this is 2014, Ferrari sold 7,255 cars over the entire year. That's amazing if you think about it, because a typical auto company, especially a large one, could sell millions of cars. Ferrari sold only 7,255 cars. If you see the breakdown, it's all over the world. Wherever you have the super rich is where you're going to see Ferraris being sold. The Middle East, for instance, which is a tiny segment of the overall GDP of the globe, accounts for a big chunk of Ferrari sales. So let's think about how you would go about valuing Ferrari. There are two narratives you can give for Ferrari, and they yield slightly different values. The first is what I call the status quo narrative, where the company continues to be run the way it is. What does that mean? Well, they're going to keep revenue growth low. Not zero, but low. Maybe 1-2% a year, which means that the number of Ferraris sold over the next decade will increase maybe 25 to 30%, maybe to 10,000 Ferraris. In the process, because they keep it scarce, they'll be able to charge higher prices and maintain their margins. And because they don't need to reinvest very much money in this growth, they'll be able to keep most of those earnings as cash flows. I'm also going to assume that by keeping it super scarce, you're catering to the super rich. And because they're super rich, maybe they don't feel the ups and downs of the economy. And that might make it easier for Ferrari to continue to sell its cars even in bad times. So you bring those all together, low cost of capital, limited revenue growth, high margins, and a relatively low reinvestment, the value that I get for Ferrari is about 6.97 billion euros at the most. Okay? Now there's another story you can of course tell about Ferrari where it goes out and exploits its brand name to try to sell more cars. I call this the Revved up narrative. So instead of selling only 10,000 cars in 10 years, Ferrari could double its sales to 16, 17,000 cars. Now, in the process, I think it has to accept slightly lower margins, not just because it has to cut prices, but because there's an element of selling involved here. You got to increase your selling costs, and those costs are going to eat into your margins. Your reinvestment obviously is going to be higher because you got to produce more cars. And finally, because you're now trying to attract somebody who's not super rich, maybe just super rich, you are a little more exposed to economic ups and downs, which means you'll have a higher cost of capital. You bring those factors together, the value that I get for Ferrari is actually slightly lower with this storyline than the one that I got for the Status Quo Narrative. With the Status Quo Narrative, I think I said it was 7.3 billion euros, really $7.3 billion that I got. With this narrative, I get a slightly lower number of maybe 6.8 or 6.9 billion dollars. So if you ask me, at least based on my numbers, I think Ferrari is worth more preserving its existing business model of not selling as many cars and keeping its margins high. Now you might wonder where the brand name premium is, right? So here's my response. When I valued Ferrari with either the Status Quo or the Revved up, I've given it incredibly high margins. Remember I told you the operating margins for the auto business are only for about 4.5%. I'm assuming margins of 15% in the Revved up scenario and 18% in the Status Quo scenario. And that shows up in a lot of different places. If you take my estimated value for Ferrari and divide by revenues, you get 2.10. In contrast, the typical auto company trades at 0.94 times revenues. You look at my enterprise value estimate divided by the invested capital, I'm giving Ferrari about twice its invested capital. The typical auto company trades at roughly invested capital. I'm giving Ferrari about 12.6 times EBITDA. The typical auto company trades at 9 times EBITDA. I'm giving Ferrari a price-earnings ratio of 23, and the typical auto company trades at 10 times earnings. And finally, on the price-to-book ratio, I'm giving Ferrari almost twice the price-to-book based on my estimates of value as the typical auto company. In other words, I've already built in a hefty brand name premium into my estimates of value, and adding an additional premium just because you have a brand name would be double counting. Now, of course, there are some twists in this IPO that have to be thrown into the process. The first is in any IPO, you have to figure out what's going to happen to the cash coming in from the offering proceeds. In the case of Ferrari, that process is made simpler because it's very clear in the prospectus that Ferrari is planning to take this cash out of the company and give it to the owners, in this particular case to Fiat, to cash out their ownership. So that cash can be ignored in the valuation. If it had been kept in the company, I'd have had to add it on to my value. The second is, notice that I've stated the value of equity in Ferrari. Overall, I haven't given you a value per share. That's because the number of shares is in flux. In fact, if you look at the prospectus, there are no shares specified because the investment bankers, when they set the offering price, have to jointly set both the number of shares and the price per share. And in a sense, the number of shares is arbitrary. Let me explain. The value that I get for Ferrari is about 7 billion. If I decide to create 1 billion shares, that'll work out to $7 per share. If I create 100 million shares, that'll be $70 per share. So in a sense, you tell me how many shares or what your preferred price range is. I'll create a number of shares to deliver that price range. So then the key value is not the price per share, but the overall equity value. And finally, there's a control issue. Ferrari right now is controlled by Fiat, and the Ferrari family is 10%. Post-IPO, not much is going to change, partly because even the shares that are being sold are sold with less voting rights than the shares that remain. The existing owners of the company, which would be Exor, which is the the investment arm for the Agnelli family and the Ferrari family will get twice the voting rights as the rest of us. And the end game is with about 33% of the shares, they will control about half the voting rights in the company. Effectively, I see little chance that the rest of us will be able to change their minds if they decide to do something. So I don't think there's going to be much of a discount attached to the lesser voting rights shares. So I'm not going to exert myself in trying to figure out how much of that discount should be. I'm just going to take the total value of equity and divide by the number of shares. Now, what are we comparing this to? The talk right now is that Ferrari is going to go public around 10 to 12 billion. I'm not sure how much substance there is to that talk, but given how widespread this talk is, I wouldn't be surprised if it did go public at 10 to 12 billion. And I wouldn't be surprised if it were oversubscribed. Why? Because it's an incredible brand name. People are going to be attracted to the brand name and they're going to feel the urge to pay a high price. I just think that if they pay $11 to $12 billion value for this company, the company has to deliver on two counts. First, it's got to be able to double the number of units it sells, number of cars, which won't be a problem by itself, but it has to be able to do it while preserving its margins. And that's, to me, a tall order. That's why I will not be subscribing on this IPO, but you have to make your own judgment. So tell your own story about Ferrari and see what you get as a value. Thank you very much for listening.